Hey, in this video, we're going to be talking about option credit spreads, put spreads, call spreads. I get lots of questions, a very popular topic these days. People ask me, Lee, can you tell me how to do option credit spreads? I want to sell put spreads. I want to sell call spreads. I want to collect income. So can you please make a video and explain how to do credit spreads? So in this video, we're going to be talking all about option credit spreads, not debit spreads, credit spreads. All right. So if you're interested in learning about how to sell credit spreads, whether you sell put spreads, call spreads, or both at the same time, I'm going to show you how to do it. I'm going to show you how to pick the strikes. I'm going to show you the odds of the trades and show you how to figure out how much money you'll get, how much money you'll have at risk, and all that other good stuff. All right. So if you're interested in learning about credit spreads, watch this video. All right. Let's just jump right in here. All right, everyone, Lee Lowell here from smartoptionseller.com. Today, we're talking about vertical credit spreads. So I have my cheat sheet here. I make these little outlines to help you understand what we're doing here, what it's all about. So the Smart Option Seller Guide to Selling Option Credit Spreads. In the options market, obviously you can buy and sell options, but today we're talking about selling options only, selling option spreads. And in this case, you're going to be taking in a premium. You're going to be collecting the money from the option spread buyer, and that money is going to go right into your pocket, right into your account. So as the option seller, you're the one collecting the money. That's why people like to sell options, because they collect the money. At the same time, you have to understand, selling options can be risky, can be quite risky, especially if you're selling naked options, especially naked call options, which is probably the most risky strategy that you can ever do. But if you do an option spread, you have a max risk. Your risk is limited because not only are you selling one option, but you're also going to buy another option as protection. So you're protected there from an unlimited loss potential, but you can still make a decent income. So let's just talk about how to do it, what they are, and how to set up the trade. Okay. So we're talking about vertical credit spreads here. And what does vertical mean? Vertical just means in the same option month, the same expiration date, you're going to be choosing option strikes that are just different than each other, but in the same month. That means they're vertical. If you look at an option chain, you're looking at the strikes vertically. A horizontal trade, which we're not going to talk about today, is just you can use the same strikes in different expiration months. So that's why they're called horizontal. But today we're talking about vertical spreads. And in put spreads, when you want to sell a vertical put option credit spread, what you're going to do is right here, you follow my mouse, we're going to sell a higher strike put option and buy a lower strike put option as the protection. Okay, so you're going to sell one and buy another all in the same month. If you're selling call option credit spreads, what you're going to do is you're going to sell the lower strike call and buy the higher strike call option. That way it helps lock in any potential unlimited losses. And you can choose any width you want. Some stocks have 50-cent wide spreads, $1 wide spreads, $2 wide, $5 wide, doesn't matter. You choose whatever width you want. And the width is just the distance between the strike prices. And here, in the example, a $5 wide spread would be, for example, the 100 strike and the 95 strike. That could be calls, that could be puts, doesn't matter. But it's a $5 difference. That's why we call it $5 wide, okay? And when you sell the spread, you're doing it for a net credit, which means you are collecting money. You're not buying, you're not paying a debit, you're selling it, so you're collecting the credit. That money goes right into your account. And here's very important, this one right here. If you're selling these spreads just to collect the income because you're not interested in being assigned or exercise shares of stock, you have to choose strike prices that are not likely to get hit by the stock by the time of the expiration date, which means if the stock is here, whatever this fictitious level is, and you don't want to be assigned or exercise, you got to choose strike prices that are pretty far away from the current price of the stock to give you a good buffer that the stock is not likely to reach. And we're going to look at the option calculator, the probability calculator. I'm going to show you how you can see your odds of that happening. And let's see, where are we here? So you use a probability calculator to help you see the odds. Now, if you choose strike prices that are closer to the current price of the stock, yes, you're going to get more money for that credit. When you sell that spread, you'll get more money. But at the same time, you're taking on more risk because the stock could blow through those strike prices rather quickly if there's, a big move in the stock. So it all depends on your risk tolerance, how much money you want to receive, and how nervous you are of the stock making large moves that could, penetrate the strike prices. All right. So down here, now, obviously, there's no guarantees with these kinds of trades. Losses can occur. So if the stock starts moving against you, then you have to figure out, well, what's my end game? How do I get out? Do I have a stop out point, or am I just going to hold until the end and take the maximum loss if that's okay with you? So you have to understand, some people want to cut their losses, so you have to figure out what's your stop out point. And the stop out point could be based on, where the stock is trading, or it can be based on how much money you're currently at a loss within the spread. If you sell a spread at a certain price and now the spread has gone up, that means you have to buy it back for a larger value, which will lock in a loss. So you have to decide, how much money are you willing to lose? If you're willing to lose the whole thing, then it doesn't matter. You can hold on till the very end. So it's completely up to you. All right. And these spreads here have a defined risk and defined reward, meaning once you sell the spread, the risk is capped and the reward is capped. You can't make any more money than what you sell the spread for. Whatever you sell the spread for initially, that initial credit, that's the most money that you can make on the spread. And also the loss is going to be capped as well. All right. So down here, how do you win on the trade? When you sell an option spread, how do you actually win? Well, you win if you hold it all the way to expiration, is for the stock not to penetrate the short leg of the spread. And we'll discuss that as well. So you can hold it until the end. If the stock doesn't move into either of those strikes, you collect or you keep all the credit that you initially sold the spread for. All right. Or you can buy it back cheaper. If you sell the spread for $1 per spread, you can buy it back for, 75 cents a spread, 50 cents a spread. You don't have to hold on to it until the very end. You can buy it back whenever you wish. If you've locked in, if you've got some money captured, you can lock it in, buy back the spread, and the trade will end. Okay. And two things here. Big caveat is that if you're doing the spread and you're holding until expiration and the stock is kind of teetering like right near the strike prices, you have to watch the after hour session. Most people think the stock market closes at 4 p.m. Eastern time, which it does, but the stocks trade in the aftermarket until 8 p.m. Eastern time. So if there's some crazy news that comes out after 4 p.m. and the stock moves, it could move through your strike price. You have to stick around till at least 5:30 Eastern time. I think that's when most brokers have their cutoff, is around 5:30 Eastern time. So you have to stick around for that extra hour and a half after the 4 p.m. close just to watch your stock to make sure it's not blasting through any of those strikes. And lastly here, you have to be approved by your broker to sell option spreads. That's it. If you open up an option trading account, you have to tell them, what kind of trades you want to do. And if option spreads is something that you're looking to do, you have to tell your broker that you want to be approved to sell spreads. Okay, so let's look at an example here. We're going to look at selling a call spread. We're going to look at selling a put spread, and we're going to look at doing them both at the same time, which is called an iron condor. All right, so let's just pull up a chart here, and let's take a look at. We're going to look at Tesla. All right, so Tesla is a stock in the news, Elon Musk. But Tesla, here's the daily chart of Tesla, hit some highs near 490 back in towards the end of December 2024, and has just been going down, 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 down. Now here, this line right here, this is the 200-day moving average, and it just tagged it right there. So this could be a support level for Tesla, maybe not, but it closed around looks like $290 or so, $290 per share for Tesla. Now, let's just say you're interested in, you have a bearish bias, you want to sell some call spreads on Tesla. So if you have a bearish bias, you think the stock might be continuing to go down, you want to sell call spreads. On the conversely, if you think Tesla's bottom here and you don't think it's going to fall any further, you can sell a put option credit spread. So we're going to look at how to do that as well. All right, so Tesla's finished the day a little over $290. Let's go into our interactive brokers here platform, and I want to show you how you could set up these trades, how much money you can consider getting. All right, so if anyone's using interactive brokers, this is how I personally set it up. I have an interactive brokers account, and this is how I set it up to see spreads. Now, the panel here is this is a quote panel. So any stock or option that you put in this quote panel, it will give you the bid and ask prices. Now, I film these videos on the weekends, so some of the prices aren't going to show up because the market's not trading right now. But I want to show you how you do this. In the quote platform here, you just click on an empty line, and we type in the symbol for Tesla, and you click on go, and it's going to bring up this big menu here. To set up an option spread, this is how I do it. You scroll down to combinations, and you choose option combos smart. The smart is the smart exchange, meaning interactive brokers is going to send your order to the best exchange that has the best prices at that time. And it'll also give you quotes based on the best quotes at that time. So we click on smart here, and it's going to bring up this other box, which is a combo box, and you could pull up any kind of spread you want. So you choose the strategy tab right here. There's 3 tabs. You can see strategy tab, and it pre-fills in Tesla. The drop down here gives you all the different kinds of spreads that you can do. Okay, but right now we're looking at what's called a vertical spread. We're going to set up a call spread, and we're going to set up a put spread on Tesla. Then we'll do the iron condor. So in this case, we're the sellers here. So you click the drop down box. It's going to sell the combo. You're going to be selling the spread. Now in this case, we're going to choose, let's choose the May expiration. Click on May, and now you have to choose whether it's a call spread or a put spread. In this case, we're just going to set it up first, a put spread, choose the puts, and now you have to select the strike price. Now we know Tesla closed around $290, and if we're selling a put spread, we want to choose strike prices below the current price of Tesla, which is around $290. So we're going to go out of the money. Let's just say we choose, let's go, I don't know. How about we try the 240 put? We're going to sell the 240 strike, and we're going to make it a $5 widespread, and we're going to buy the 235 strike. So here it's telling you what you're doing. You're going to sell the 240, and you're going to buy the 235. And you click on add, and it's going to, would you like to add the underlying? Yes, we want to have the Tesla stock price in there as well. Okay, so it added in here. I just want to, let me move the screen over here. Okay, so now what we have here is, we can move this up here. So now you have the Tesla stock price. So it closed in the aftermarket, $294 and change. Here's how it went out. Now what it does for you, it sets up 3 lines. Number 1, it has the actual spread, the 240, 235 put spread, and it gives you the individual legs as well. Now, the bid and ask columns is the only thing that really matters to you. And you can see here how the spread went out, bid and ask. So the 240 put went out 1150 bid at 1175 ask, and the 235 puts 1030 bid, 1055 ask. Now, when the market is open, this spread line here, which is empty, will also show you a bid and ask price. Okay. Now, in this case, if you want to know what the fair value is, you subtract the bids from each other and you subtract the asks from each other. You can see this is worth about $1.20. Subtract 1030 from 1150. That's $1.20. And this is also $1.20. So you know the midpoint of the spread, the fair value of the spread is about $1.20. So if you're looking to sell this spread, you're going to try to sell it for at least $1.20 per spread. Okay. Now, if the market was open, you would see something like $1 bid at $1.40. Okay, that's showing you the bid and ask. What you would do to place your order, you would sell it in between. So here's how it works. Let me shut this screen down here. If you want to invoke the spread, if you want to sell the spread, you click on the bid column. So I'm just going to click in here, and it's going to bring up a new line. Okay, we're going to sell the spread, and since there's nothing here, we're going to put in $1.20. But if the market was open, it would show you some numbers in here. Now, what we can do is we can check the margin. Now, what this is going to do is going to show you what you're about to do with the spread. Let me shut this down here. This is just a chart that shows what's going to happen. So here's what it has. It gives you the trade that you're about to do before it actually goes through. So you're selling the combo. You're going to sell the 240 put and you're going to buy the 235 put, $5 wide, and you're looking to sell it for $1.20 credit, where it has a C here. Okay. Now in this case, it's a $5 wide. Here's how you figure what your potential maximum risk and maximum reward would be. Now we know the maximum reward is $1.20 because if you're selling it for $1.20, that's how much you're going to get. Now $1.20, you have to multiply by 100 to give you your actual dollars that you're going to get. So it's $1.2 per spread, which is actually $120. So if you sell this spread and it's executed, you'll get $120 in your account. Now, in order to figure out your maximum risk, you subtract the 120 from $5 wide. So 5. So subtract 120 from 5. Your maximum risk is $380. 380 plus 120 equals the 500. All right, so you're risking $380 to make 120. Now, that may seem weird because typically you want to make more than what you can lose. But when you trade credit spreads and you have the cushion, you're gonna get less than what you risk. Okay, so I'm not gonna place this trade here. So basically, that's what's gonna happen. All right, now we know that Tesla's $294 and change. You're all the way down at the 240. So you have roughly a $54 cushion below the current stock price. And you're saying, okay, I don't think Tesla's going to fall another $54 by the May expiration date. All right. So now if you want to choose the call spread, so we go through the same process. We type in Tesla, click enter. And once again, we're going to go to option combos. And now we're going to once again, sell the combo. This time we're going to choose the call side. Now, once again, you have to choose the strike prices, above the current price of the stock to give yourself some cushion. So if Tesla's at $294, let's go up to about 345. We're going to choose the 345 strike that we're going to sell, and we're going to buy the 350. Once again, $5 wide. We're going to add it here. Okay. And this other box comes up, tells you what you're doing. To sell the spread, you're going to sell the 345 call. To buy it, and then you buy the 350. If you were to buy the spread, which we're not talking about, it would mean that you buy the 345 call and you sell the 350. It's just showing you what things that you can do for that spread. Let's close this out. Now, here's, once again, it gives you 3 lines. It gives you the actual spread and each leg. These are called legs. Now, you can see, subtract the bids and offers from each other. So this is about $1.20 bid at $1.25. So the midpoint is somewhere about $1.22, $1.23. And in the spread line during market hours, you would see something, again, roughly like $1 bid at $1.40 offer. And when you go to sell the spread, click on the line here, and we're going to put in, and you're going to sell one. You can pick as many contracts as you want. We're going to choose one. And again, we're going to go for $1.23 in this case. Okay. And if we were to sell this thing, you can check the margin first. Once again, this little graph here shows you the profit and loss potential. The most you can make is going to be $1.22 if we're filled, and the most we can lose is whatever 5 minus 122 is $378. That would be your maximum loss. Okay, so that graph just shows you what's going to happen. You can see some other details in here. I don't typically use that. All right, so once again, you're going to sell the spread. You're going to sell the lower strike call, buy the higher strike call, and collect $1.23. All right, so your maximum risk would be $377. Okay. And down here, it just gives you a little bit more information about what's about to happen. It tells you what your commissions will be, what your margin requirement will be. Now, the margin requirement is just whatever the maximum risk is. In this case, it's $373. So your risk should be no more than $373. Okay, you can look at that. Depends on how your broker does it. All right, so now we've got the put spread, we've got the call spread, and let's just discard the orders here. Okay, so depending on your directional bias, if you're bullish, you're going to sell the put spread. If you're bearish, you're going to sell the call spread. Now, if you think that Tesla's just not going to go anywhere, any stock's just going to remain flat, you can sell both spreads at the same time. Now, in this case, you can just do one after the other. You could sell the put spread, then sell the call spread. But if you want to do all four legs at the same time, you can create what's called the iron condor. That way you don't have to do the put spread, then the call spread. In this case, the iron condor, you can get it all done at the same time. So let's load that up here. Let me show you how to do that. Once again, combos, option combos. And in this case, we're going to do the drop down, and we're going to go through look for the iron condor. Okay, so here it is. Now it says buy combo. In this case, that's what you want, because you're gonna sell the more expensive leg. So you're gonna choose, once again, May, and in this case, we're gonna sell the what puts did we have? We had the 240 and the 235. So we're gonna select the 240 puts that we're gonna we're gonna buy the 245 puts, and we're gonna sell the I'm sorry, hang on a second. We want to buy the 235 put. Hang on a second. Do we sell this? Let me see how we're doing here. Let's cancel this and start over. Hang on. Tesla, combos, option combos. Sometimes it's a little tricky with the combos here. We want to sell, let's do the May, right? And we want to make sure that we can do this properly. We're going to buy the 235 and we're going to sell the 240. Okay, there we go. And now the calls, we're going to sell the 345 and we're going to buy the 350. All right, so there's $5 wide in between buying, selling the more expensive option, and we're going to click add. Okay, so here's just your window here telling you what's going to happen. And now it's set up. So what it does is now it's got the whole thing here, but since the legs are already on your screen here, these are not going to duplicate down here underneath. So it's got the 235, 240, 345, 350 condor. If you hover your mouse over here, it just, let me move myself over here. It just tells you what's going on here. All right. And so when the market is open, it's going to have the spread here. So if you're going to sell both $1.20 here and $1.20 here, the spread would be worth roughly $2.40. It'd have like a $2 bid at say $2.80 or something like that, or $2.20 bid at $2.60. You know you're going to sell it for $2.40. So we can type in here $2.40. Okay. Now when we go to check to see what we're about to do, it's going to tell you. Now this is what a condor, iron condor looks like. Okay, your risk, your reward is capped at the $240 or $2.40 per spread, and your maximum risk is the $260. Remember, $5 wide, but now you've collected $240, so your max risk is $260. Okay, so you can see this is what the chart looks like. So what you really want to happen is you really want Tesla to really not go anywhere. Okay, so let me move this over. Let me shut this one down, shut this one down. And that is not going to be executed, obviously. So the only problem with making these setups right here is that when the market's not open, it's not giving you all the prices. But this is how I do it in my interactive brokers platform. This is how I set up the trade. So this way, during the day, you can not only see the individual prices, but you can also see the prices for each spread. Unfortunately, those prices are not showing up today. Now, the other thing I wanted to show you is the odds. How do you know that that the stock isn't gonna, penetrate one of the legs? So what you want to do in that case is, if you're worried about it, if you don't want to take exercise or assignment, you're going to want to check a probability calculator. Now let's go to our website here, smartoptionseller.com, and we're going to look at the probability calculator. Now, this is something that you can get on our website. If you go to our services tab, here's our probability calculator right here. You can click on that. So here's how we do it. We're going to put in Tesla, $294, and we're looking at the May expiration, which is the third Friday in May, May 16th. And what's the volatility we're going to use for Tesla? Let's look at Tesla. Volatility is roughly, let's go to May, and the volatility is about 63%. You see this thing right here? It says ATM IV, at the money, implied volatility. So we use about 63% in the volatility. And we're going to see what the chances are of the stock penetrating either side. So in this case, we're going to look at the puts first. So we're going to put in 240. That's on the downside, 240. Use it for both targets, and you click on go. Based on its current price, based on the expiration date, and based on the volatility, it will tell you the odds of over time Tesla getting to your 240 strike. Now, here's what you need to be careful with. Finishing below lowest target. Now, if you just want to collect the income, you don't want Tesla to fall below 240. So here's what the chances are of that happening. There's almost a 24% chance by May 16th that Tesla could finish below $240. Okay. Now, is that a small enough percentage for you? Maybe you're thinking, Tesla might fall that far. I want to choose strike prices that have less of a chance. So you can use the probability calculator here. Let's just say you chose the 200 put. Let's just say you sold the 200 spread and sold the 200 put and bought the 195 put. Much further out of the money, you'll collect less money for it, because the further you go out of the money, the less money you get. Let's see what the odds are there. So if you take it down to the 200 strike, now there's only less than a 9% chance that Tesla will fall that far. So maybe that'll be more comfortable for you. Okay, you'll receive less money, but there's less of a chance that Tesla can fall that far. Now on the upside, we were looking at the 345 strike, and we put that in both boxes, and you click on go. So in this case right here, finishing above the highest level. So if you just want to collect the income, you don't want Tesla to move up above $345. In this case, there's almost a 29% chance of that happening. That could happen. So if you want less of a chance, go up even higher. Let's look at the 395 level. Let's go up another $50. Click go. Okay, so now there's only a 15% chance. 15% chance. You never know. Tesla bulls could come out. So you have to decide which strike prices will give you the most cushion. That's up to you. The further out of the money you go, the less you will collect. But as I said, the less chance the stock will move with it. So you have to, once again, weigh out, how much cushion you want to get versus how much money you will get. So, what you do is, you go through the strike prices here. And let me move myself up here. And, on the call side in May, you can, see how much the options are trading for. You can check the prices in between the spreads and see how much cushion you're willing to take. On the downside, you just go down, lower in the strikes and the puts here, and see how much. You only need to look at the bid and ask comms. See how much you can get. Subtract the bids and subtract the offers from each other. That gives you the fair value. And then you can see how much cushion you'll get. So really, that's about it. That's how you do it. Okay. So if you're interested in collecting premium, you sell credit spreads, you can sell just call spreads, you can sell just put spreads, or you can sell both at the same time if you think the stock's not really going to go anywhere. But if the stock does start moving towards one side or the other, then you can either figure out, am I just going to hold until expiration? Do I have a stop out point? Or you can even consider rolling it out to a further out expiration. And that's another topic for another day. All right. So that's it. I hope this is giving you some good information on how to do credit spreads. Let's go to our website real quick, smartoptionseller.com. and show you what we have. We have a free ebook here. It's all about put selling. If you know nothing about selling put options, get our free ebook, scroll down, put your name and email address in here. We'll send you an email with a copy. Here's our services tab. We have a couple newsletters. These are all paid services. We have a couple newsletters that we run. We have our one-on-one coaching sessions and the probability calculator that I just showed you. Very cheap price. You can look at getting that as well. All right. Send me a question. Send me an email. I'll always answer. Give me a thumbs up. Give me a like. I hope this has been helpful to you. Leave a comment down in the description below. I've got links and websites for and books for, to help you out. Take a look down there in the description below. And on the screen here, I'm going to put another video on. I'll see what it is. I'll pick out a good one for everyone. All right. That's it for me today. Make these free videos for the trading community. I'll see everyone in the next one. This is Lee Lowell signing off.